Welcome. Thank you for joining me for this presentation. My name is Eric Amzalag. I am a certified financial planner in Southern California, and this presentation is called Navigating the Retirement Risk Zone. This is the most important retirement presentation I think anyone can watch. The objective here is to show you what is the retirement plan that people who are navigating this phase of life, which the retirement risk zone is the 10 years prior to your desired retirement deadline and the first 5 years of retirement. And the reason it's titled the retirement risk zone is because this is the period of time where you are probably the wealthiest you have been in your life and where you are most sensitive to changes in market conditions, but also have the most consequential financial decisions you'll have to make as you lead into retirement. So, this presentation, we're going to talk about all those things. We're going to address how you improve the probability of your retirement success, how you increase the lifespan of your assets, and also the spendable income you can generate from your assets. Now, I should say from the outset that this is very contrarian. This is geared towards people who, one, fundamentally don't believe that the transfer your assets over, invest it, set it, forget it mindset will work. It's geared for people who have been aggressive savers over their life but aren't sure if they have the assets in order to successfully navigate retirement or retire at the time they'd like to. And so I hope you will watch this video with an open mind and learn a lot from the things I show here. I am going to show in the first half what are the things that we consider, and then in the second half, what are the actual practical implementable steps you can take to improve your retirement outcomes. Okay, so bear with me as we go through this, and let's just jump right in. What we're going to do first is talk about the three big retirement questions, and these are the things every pre-retiree and retiree needs to answer. The first one is, are you on track for retirement? We all have this desired retirement date in our mind. We don't know exactly when that is, but oftentimes we simply don't know if that's actually practical or possible. If I'm 55 and I say I'd love to retire at 62, the question is, can I do it? And then how do I define whether I can do that or not? We need a way to define it so that we can then run some models and test it. So the question number one is, are you on track for retirement? And not just on track for retirement, but on track for the retirement that you desire. It's no success if you retire, but you have to cut your spending by 50% and live off tuna fish and cat food in order to make it work. That's not success. The second question is, when can you retire? When is the appropriate age to retire? Right? So the idea being, if you change nothing about your current behaviors, you do everything you're currently doing as they're situated. You save the same, you work the same health. The question is, when can you retire? At what age can you retire? And I'm going to show you how we define that. There is a mathematical way to define that. And then the third question is, how can we make your money outlive you? And most importantly, this is kind of a two-faceted question. Because what it really means is, can you retire at an age you'd like to retire at, spend the amount of money you'd like to spend in retirement, meaning have the desired quality of life you desire, and while doing those things, can you also make it so your money outlives you? Because the worst case scenario in retirement is you retire, you make the decision in a vacuum without the right information, and then you live and you run out of money before you have your bad health or long-term care years, and suddenly you're a huge drain on your kids or on society or whatever. There's a huge problem there. Nobody wants to be in that position. So the question is, can we achieve these outcomes, but then also make it so you and your money, time, you're passing, so to speak, at the same time, or that you have your money outlive you and, if you're blessed, pass some on to your heirs. Okay. So we have to frame this whole presentation with that. The whole idea here is we are going to answer the three big retirement questions. We're going to do that from a practical standpoint that talks about the things that are in your control that you can do in order to execute the strategy. All right. Now, I really want to frame this. I have done this presentation many times. I usually title this presentation, The Secret Retirement Plan Big Finance Doesn't Want You to Know About. And the reason is because Big Finance wants you to turn your investments and your assets over to insurance companies or annuity companies or even investment managers with, sight unseen, no questions asked, and think that you have no power over the outcomes in your retirement. And that is simply not true. I am going to show you today that you actually have a whole bunch of behavioral, high probability things that you can control that will influence and improve your retirement outcomes, and that you don't need to defer your power. Now, this isn't a case to never work with a financial advisor at all. In fact, I'm a financial advisor, I'm a certified financial planner. I'm not trying to talk people like myself out of business. What I am trying to say is you have a lot more power than you think you do, and the big finance or media around that is intentionally stupefying you and paralyzing you into inaction so that you'll defer your power over to lazy money managers and expensive funds in the hope that something they do, they have some secret sauce, Michael Jordan's sweat from Space Jam, whatever that is, that will somehow push you over the threshold. And that is just not true. So keep going with me. If that resonates with you as it does with me, and I'm very mission driven by this model, then we may find some common alignment here, and hopefully this video will help you. So um, how do we answer the big three questions? Well, the first step is always to test the probability or the risk that you run out of money while you're alive, right? So I said before, what we need to do is say, if you change nothing about your behaviors now, let's create a controlled test of what your retirement probability is if you change nothing about your behaviors and you retire at the age that's appropriate, and then we test the risk probability of you running out of money while alive. All right. And we do that through some statistical models. We put data into a calculator. We say, hey, if you need to take this amount of income for this many years and you start doing it at this age, what's the probability you run out of money out of 1,000 scenarios? And you use a sophisticated computer tool that will run all these different scenarios. And the scenarios might be good market outcomes, bad market outcomes. One partner dies early, you get fired early, you keep working longer. Like, it's just a whole bunch of amalgamation of different retirement possibilities. And we want to see a high probability on that calculator. And I'll show you an example of that. The second thing we want to do to answer the big three is we want to see, can we make adjustments that will, one, allow you to retire earlier, right? So that's awesome. If your portfolio and your savings and all the things you've done to prepare yourself can allow you to do so, you may retire earlier if you desire. And if you don't desire to retire earlier, the benefit of being able to retire earlier is likely an increase in available spending in retirement. So that leads to our second, which is, can we make adjustments that will allow you to spend more money while alive? And then the third is, can we increase or optimize what's left of our money for our heirs? Okay, so you can do all those things in tandem. And that is one of the key facets of working with a financial advisor or financial planner like myself, which is we're thinking through this lens. We're thinking, okay, if we take what you're doing now and you change nothing, and I show you what is the probability or likelihood of you retiring with the quality of life that you desire, and then I show you, hey, here's a list of all these behavioral adjustments and some investment adjustments as well that you can make that will allow you to either retire earlier, spend more money, or increase and optimize what's left over for your heirs, right? So that's how we answer the big three. So let's talk about what's the framework we're going to think this through. Everything comes down to cash flow. Can't answer those questions without understanding cash flow. And what I mean by cash flow is we have to understand how much you're going to have in income and what you'd like to spend. And then we use that as the base or the pillar of any retirement model we run. And I'm going to show you exactly how this scenario transpires. So the ideal pre-retirement scenario is something like this. When you're employed, your income and expenses generally look like what I have on the screen. You have this big green arrow, your income is $100,000, and you have this shorter red arrow. And the red arrow is your spending, and that's $85,000. Let's just use fake numbers. In this scenario, you have a green bubble here, which is what I call your savable amount. You spend less than you make, you save $15,000 a year, it goes into your 401k or IRAs, taxable money, whatever. That's an ideal pre-retirement scenario. Now, what happens when we retire is we face what's called the income inversion, which is you actually reverse. So now your expenses are usually wider. This red arrow is wider than your income. You can see that pictured here. And what happens is you have this red bubble here, and that's called the gap. And in a second, I'm going to show you how we actually calculate this. But the whole scenario in question here is when you're thinking about retirement success, what you are actually thinking about is, can my portfolio and saved assets support that red bubble, which is the gap between my other income sources and what I'd like to spend? And if your portfolio can support that for the rest of your life, you have a high probability of retirement success. And if it cannot, you have a low probability of retirement success. Let's look at this a layer deeper. I'm going to skip this slide, but the idea here is, what is retirement income planning? It's actually figuring out how we construct the income to fill that gap in the most optimal way that extends the lifespan of your assets. But let's talk about this. So I'll give you an example on the screen here. So in retirement, you're going to have two sources of income. You're going to have what's called guaranteed income and non-guaranteed income. Guaranteed income are things that you don't need to be in control of the portfolio construction or paying yourself. A good example of that is Social Security. You just get a check from the US government. You don't have to determine what it's invested in or how do you handle inflation, none of that stuff. They just give you a check, you cash it, you live on it. Boom. Awesome. That's called guaranteed income. There are two other sources of guaranteed income: pensions and annuities. Okay. Now, they all come with trade offs. The best form of guaranteed income is Social Security. The second best is a pension, where your government bears all the, I mean, your company bears all the risk and you just get a check. With the pension, you run the risk that your company goes out of business or files for bankruptcy. They can no longer pay you your pension. But in general, for the companies that are still offering pensions, that's a low level of risk. With annuities, you're actually, shoving that risk off to an insurance company, and you face a whole lot of other risks with that. Insurance companies charge you a lot of money for an annuity. They can go out of business. There's a whole bunch of trade-offs, and I won't go into that in this video. I have other videos about that subject if you visit my YouTube channel. But for the purpose of this slide, what we're trying to illustrate here is, let's assume this hypothetical family or household has four guaranteed income sources, totaling $51,100. But in retirement, they'd like to spend $75,000 per year. Well, now they have a gap, and that gap is in red right there, and that's $23,900. And so the whole idea here is they have to support that $24,000 income payment each year for the rest of their life. And the question is, can they do that out of their portfolio or other saved assets? Okay, that is the heart of everything. So we have to know that first. We have to have an idea of what your guaranteed income sources are and what your desired spending is, and then we can start running models. Now, you don't need to wait till age 67 to find this information. You can get Social Security statements with projections. You can get pension statements and annuity statements, and you can also run models on your current saved assets or portfolio. And in fact, my case is, that's why I run this video, that's why I run the ads that I do. I'm trying to speak to people who are 55 and saying, hey, you should be doing this starting at 55. Don't wait till you're 65 and 1 month, 3 month, 1 year from retirement. Because the closer you are to retirement, the less time you have to implement all the things I'm going to show you in this video that can actually influence and increase your retirement success, which means increasing how much you can spend in retirement, increasing how much you leave to your heirs, bringing your retirement age to a younger age if you so desire, right? It's really, really critically important. Let's continue on. So how do we determine retirement success or failure? I've already addressed this, but the gap has to be filled by non-guaranteed income sources, such as your portfolio or savings. And success in this case is your portfolio's ability to support that gap income for the rest of your life. And failure is your portfolio's inability to do it for the rest of your life. The key thing here is for the rest of your life. It's not enough for your portfolio to support it for 1 year or 2 years or 3 years or 4. Most people live in retirement for 20 plus years. You retire at 65, have a very high likelihood of living till 85. That's the average American life expectancy is in the low 80s. Okay, so you have a high likelihood you'll live, and a lot of people live a lot longer than that. So we have to plan for longer. You are taking a huge gamble with your life if you retire with a low probability of your portfolio being able to support that gap. You will be a burden. That is just what it comes down to. So how do we measure this? So we use, like I said earlier, a sophisticated financial calculator. What we do is we input data like how much you make, what your Social Security income is going to be, what your pension income is going to be, how much you have in assets, what they're positioned in, and all this other stuff. And we run it through what's called a Monte Carlo, which is a 1,000 scenario test, where the scenarios are all different types of market performance, and you die early, you die late, you have bad health, you have more than a certain amount of years of long-term care costs, blah, 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 blah. The idea being we measure it by a percent of success out of that many scenarios. So I have on the screen, you can see it's measured by percent of success. So if you were to work with me and we were to build a retirement plan, we would be using this as the metric to track how likely are you to succeed with your current behaviors. And then we might throw a bunch of proposed plans or other scenarios where I make recommendations and say, well, maybe you should try this and this and this and this. And if you do those things, we can bring your success rate up from 35% to 99%, let's say hypothetically. So what are the actual things we can do to improve our probability of retirement success? Okay, number one, we would want to try to increase our guaranteed income sources if it's possible. Okay. Now, there are some very easy ways to do that through Social Security claiming. That's something you don't trade dollars for in order to increase it. You can delay or defer Social Security claiming if possible. And there are some things to evaluate within that, but you can do that. There are also ways to do that with your company pension. When it comes to annuities, you have a lot less control. I'm not generally a big fan of annuities. That's a separate video topic and a separate conversation. But there are some small ways, but you will have much more limited abilities. But the thing is, the areas you do control regarding your guaranteed income are guaranteed. They're things you control. It's not about selecting an investment. You can actually say, I will work one more year, or I will defer Social Security one more year, and in return, I know exactly what dollar amount increase I will get in monthly payments. All right. The second thing we want to do is improve the reliability of our income from portfolio assets and savings. And we're going to talk about these in a second here. All right. So those are our two methods. So let's look. I like to think of these by breaking the actions you can take into what I call high probability actions and low probability actions, because we have to think about this way. I'll give you an easy example. Trying to guess and time when to invest in Bitcoin is a low probability action. It's not repeatable. It's not a reliable strategy. I won't make any money or succeed as a financial advisor if I went to all my clients and I said, hey, let me help you time your entry into Bitcoin, because that's out of my control. I don't control price action on Bitcoin. So let's talk about what are the high probability actions and the low probability actions. So number one on high probability actions is you can increase your savings rate. Now, we'd have to talk about whether that's possible and what trade-offs exist if you were to be proposed that suggestion. But that is the number one most guaranteed way to improve your retirement success. Save more money, create more investable dollars, bing, bang, boom, you have more money at in the pot of gold at the end of the rainbow to use for your retirement. Second high probability action, Social Security claiming. We kind of just talked about it. I won't repeat it, but very high probability. You know what you have to do. You do it or you don't do it. You get a guaranteed increase in your Social Security benefit. Number three, we call this asset location. Asset location is about choosing where to save your money into the right account so that you have the most tax efficient method of withdrawing that money, but also the most tax efficient method of passing that money on to your heirs. Now, you may not have known how to do that. You may be 55 or 60 or 63 or even 70, and your assets are where they are. That doesn't mean it can't be changed. In fact, it can be changed. And oftentimes, a reliable retirement strategy is to strategically think about how to change the location of your assets so that you have a more tax efficient way to withdraw them, and therefore keep more of your hard-earned money, which means you have more spendable money, right? The less you give to the government, the more you keep and spend. Simple as that. Number four here of high probability outcome or high probability actions is changing your asset allocation. And this is a topic for another video, but I will give a short explanation of this. Asset allocation is simply a measure of how much risk are you taking on with your investment portfolio. It has nothing to do with what investments you select. It doesn't have anything to do with Amazon, Apple, Microsoft, or 30-year treasury bonds. That's not what it's talking about. It's simply talking about how much risk are you taking on with your investments. And this is really critical to understand the next thing I say, which is you as a retiree only need to take on as much risk as is necessary in order for your retirement plan to work. Let me repeat that. You only need to take on as much risk as is necessary for your retirement plan to work. And what a good retirement plan does is it tells you what is the rate of return you need to seek on your investment assets in order for your probability of retirement success to be in the optimal range. Okay, so let's say we build a retirement plan where we know your income, your desired spending, we have your Social Security, all this other stuff, and we know what your assets, your total value of assets, and the program spits out and says, hey, you need a 5.2% rate of return each year for the next 30 years in order to die without running out of money and leave some money to your heirs. Well, then all you need to do is get 5.2%. No more, no less. Now, that doesn't mean you might not want to seek a higher rate of return, and that is totally fine. But right now we live in this investment world where we have no context. Everybody is constantly seeking the highest rate of return with no understanding or way to describe the trade-offs of seeking out the highest rate of return. And I can tell you right now, simply, you seek out a higher rate of return in exchange, you get more likelihood that you will have bigger drawdowns in your portfolio. That's the trade off. You want a higher average rate of return, you're going to face bigger drawdowns when there are bad market years. Okay? So my case has been, and my work with my clients is, well, if the program says we need a 5.2% rate of return and that's reasonable and low risk, we're going to seek that out as the baseline. And if you tell me you want a higher rate of return, we might try to seek that out as well. But I am always going to explain you what the trade-offs are in a probabilistic term, meaning how likely is this to blow up your plan if we seek higher rates of return. And what you will find is if you seek higher rates of return, plans blow up because you have a lot more risk if there's an foreseen bad market event, right? So asset allocation is really critical here in understanding that this is just the measure of how much return or how much risk we're taking on with our portfolio, not what we're investing in. And the reason I separate these is because what I see here on the left side, these four behaviors, they're all behavioral. They have nothing to do about timing, nothing to do with timing the market, selecting the perfect investment or not. These things on the left here, and you'll see there's one more here, which is tax efficient withdrawals. I've already kind of addressed it. But by doing those five things, they're all within your control. They're all behavior based. They're not luck or timing or gambling or whatever. It's things you control. And these are the things that have the largest impact on increasing your retirement success, as I can show and we can talk through, but you will see this if you work with any qualified financial planner. You will find that these are the things that people control and win with. Now, let's talk about one caveat to this, which is if you have been a bad saver and you don't have a pile of investment money, nothing will help you. There is nothing that can help you. You have to hope and pray that if you have, let's just use a bad example, but if you have $5 in retirement savings and you're 64, nobody can help you get out of that. You've made a mistake your entire life and now you can't extract yourself. The challenge for most people is a lot of people in your position who will be watching this video, you might have saved 400,000, 500, 1 million. The question you are going to have is that enough? And I'm here to help you answer that question, right? That's the whole point, is we need to help answer that question. And one of the ways we answer that question is the stuff we talked about earlier. But then we can also improve on that question. We can improve on, do you have enough? If the answer is yes or close, how can we improve on it? Either way, there are good things you can do to improve on it. Now, you might have seen where this is leading, but on the right side here, I have low probability, and low probability things that improve your retirement success are trying to be a stock picker. It's a low probability method of succeeding in retirement, right? You're not going to beat the market, nor has it been shown that someone can reliably out invest the market. Now, my whole case here is we shouldn't be doing that anyways, because if you try to beat the market, you also trade off a whole bunch of risk on the downside, and most people's plans blow up because they get too greedy. I mean, most people's plans fail because they don't save aggressively enough. But you're not watching this video, I believe, you're not this far into this video if you haven't saved aggressively enough. What you are doing is you're hoping to say, how do I take what I've saved and turn this into something usable? I need a strategy. I need to understand how I navigate this. And I'm saying investment selection isn't the method of doing that. Now, I do believe financial advisors, I believe this of myself, will help pick better investments. But I also am humble enough to say, hey, that's not going to have the biggest influence on your plan success. It might have the smallest influence. It's still worth doing, but I'm going to admit that it's marginal. These things on the left side are much more impactful. Okay, so, and I have a seventh here, and this is more a personal gripe, but I don't, low probability help in your plan is using life insurance as an investment. That's a guaranteed way to pay a lot in fees and have a low probability of success. Now, there are admittedly exceptions to this. And if you'd like to discuss that, you'll see in a second here, you can schedule time with me to discuss how, if you do have life insurance, a VUL, an IUL, a whole life policy, how does that fit into your retirement plan? But let's take a pause here. This presentation goes on. I'm halfway through. So at this point, I'd like to give you guys a recommendation, which is if you've watched this far and you're interested in speaking about how your retirement plans are currently positioned, you can click the link below this video and you can schedule time with me. You can fill out a short form. It'll give me some information about what you have going on, and I will help address and answer any questions you have. It's a free consultation. You can do that all through the link in the video, the link below this video. Or in addition, you are also welcome to continue watching this video, and I will show piece by piece the set of retirement actions that I help facilitate and clients can do on their own if they'd like that will improve the odds of their retirement plan success. Okay. So you can click the link below and you can schedule some time to talk. It's free. You'll fill out a short form. I'll be able to get together with you. Or you can continue watching. So let's continue watching, or let's continue with this presentation. And let's talk about how do we optimize the probability of achieving our two primary retirement goals. Okay, so we've been talking about all this different stuff. I showed you high probability actions and low probability actions. Okay, how do we actually do this? So what are the things you can do? Now, this little picture here comes from a study called the Advisor Alpha study, and it shows the percentage increase in retirement income you can obtain through taking action on these different set of decisions that you see here on the page. I'm not going to go through each one. They're all related to the things I just showed on the prior slide. But the idea here is this study found that you can increase your income in retirement by as much as 38% by tweaking these different levers, by tuning the different levers that you see here. So the first one is Social Security. We've already talked about it, but here's some things that you can consider. So the considerations are, when do you claim? Is it better to take distributions from a retirement portfolio in order to claim Social Security later so you get the guaranteed monthly payout? Maybe. Is that possible in your situation? Maybe. Those are things we have to evaluate using calculators and models. Then you also have things like, can you optimize your spousal and survival benefits? Is your partner claiming on their own income, or should they be claiming on the spousal income? Sometimes you get more, it depends. Those are things to understand. The second thing is your Social Security income is taxable. And there are ways to minimize how much tax you pay on Social Security. It's a very complicated formula. A retirement planner can help with this. There are videos online, but the idea here is you can optimize and minimize how much you pay out of your Social Security income in taxes. Okay. Then there's Medicare claiming. Medicare is something we all will most likely all end up doing. You claim at 65, you'll end up going into the Medicare program. The thing about Medicare is your Medicare premium is determined by your income from 2 years prior. Okay. So if you made too much money, you're going to be kicked into a higher Medicare bracket. You're going to pay more in premiums. The other thing is if you pay yourself too much in retirement income from all your different retirement income sources without strategically crafting a tax strategy, you may also take out too much income and then therefore end up paying more in Medicare than you should. Okay, we talked about tax efficient withdrawals. Well, one of the things we're doing with that is trying to say, can we distribute your assets in the appropriate locations so that you have the lowest taxable income, but the most spendable income, and therefore also lower other expenses like Medicare. Okay. So we just talked about this a little bit there, but tax planning is very, very important, knowing which accounts to distribute from and what amounts so you don't bump into higher tax brackets or you don't increase the tax you pay on other parts of your income, right? Strategically planning your tax strategy is one of those things that's very high probability because it's a behavioral thing. You control it, you can model it before you take action, and you can guarantee that if you take said actions, you will get said outcomes, right? Has nothing to do with who's willing to buy Microsoft later that day and at what price. The other thing that comes under tax planning is Roth conversions, and this is Roth accounts are like a unicorn investment account. We can talk about that individually if you'd like to schedule time, but Roth conversions are a strategy where you take money from other types of taxable or retirement accounts and try to get it into a Roth account because the benefits of a Roth account are numerous and worthwhile. And Roth conversions are a tax planning consideration, right? Something we really need to consider strategically, whether it's worth doing, how to do it if it is worth doing, and in what amounts, okay? And then the other thing here, which I haven't addressed, is you actually have to draw an income from your non-guaranteed income sources, which is your portfolio assets. That is after taxes. You need, if you want to spend $60,000 and you need $20,000 of money from your portfolio, you actually need $20,000 after taxes, because in some cases you might pay tax on the distributions from your portfolio. So if you only plan for $20,000 distribution from the portfolio and you end up with $16,000 after tax, your plan's going to blow up, or it's just not reliable. We haven't input the right data. We haven't planned for the tax. We call this the tax drag on your retirement income. Okay. Then there's total wealth allocation or asset location, we kind of address this, but you have more than just your social security income, your annuity, and your investment portfolio in your 401k. You might also own a house. You might also own a car. You might also own gold, watches, whatever. You might have a car collection. I don't know what you'll have, but those things need to be factored into your total wealth allocation because they will determine what level of risk you can support or what other sources of non-guaranteed income you might have, right? You might have other sources of non-guaranteed income that are not just your 401k and IRAs. You might have equity in a home or a valuable car collection that you can eventually tap into as backup sources of income should your portfolio not actually be capable of sustaining the retirement spending you hope for, right? And that's really important to model into a retirement plan. Asset location, we talked about. Here's an easy example, but the idea being you want your assets located in the right accounts for the lowest tax friction. And a really good example of this is, you're generally going to want your stocks or stock-based funds and investments to be in a taxable account because that allows you to take advantage of long-term capital gains tax, which is very low for most people. In some cases, it's non-existent if you make less than a certain amount of money. But also, stocks pay dividends, not interest, and dividends are taxed at a preferred or more advantaged tax rate, right? So you want to take advantage of that. Whereas interest is taxed at current income tax rates, which are generally higher than capital gains. So your bonds and any interest producing investments you might want to hold in a traditional 401k or a traditional IRA or something like that. The last thing here is in a taxable account, you'll have the ability to do tax loss harvesting, which is another strategy of minimizing taxes and taking profits from investments that are winners without having to pay tax by selling an offsetting loser investment in order to extract the profit. Now, these are all individual considerations, and if you have questions about these, we should be talking about how they fit into the broader plan. But these are an example of how asset location is very important. Then you have what's called drawdown strategies. I won't go too deep into this. My personal belief is any standard templated drawdown strategy you see online, like the 4% rule or a guardrail strategy or a bucket strategy, is just a headline designed to entice you to read an article. Now, there are reasons to appreciate each of them, but the truth is they're all completely individualized. It really only, the way you're going to draw down your assets is really 100% unique and individual to you based on your retirement plan. Your retirement plan will tell us what the appropriate drawdown strategy or hybrid of all these different drawdown strategies are for you, because it's all about matching things to your retirement probability of success. The idea being, if you came to me and you said, hey, I have this much in assets and this much in guaranteed income, and here's how it's positioned, and I want to retire at 65. And I came to you and I ran the model and I said, look, your plan says you're 100% success on that. You don't need to change anything. Now, you could, but you don't need to change anything. I could give you a whole list of suggestions and they would be okay and maybe optimize you somewhat. But the truth is, you don't need to make those changes. I would also present you with a drawdown strategy, and it might not fit into any of these buckets. It might not be a 4% drawdown strategy or a dynamic one. It doesn't matter because it's all about the plan's success and how you feel about that. Does it make you feel good? Does it make you feel like you can spend your money? You should be allowed to spend your money in retirement, and you should have a plan that helps you identify how to do that. So that's kind of the end of the practical thing, and obviously there are other financial planning things that would be talked about, legacy, wills, trusts, things like that, insurance planning. There is a case for types of insurance, homeowners insurance and term life insurance and things like that. And there are even cases for investment grade insurance, but those should be done on an individual basis. And also they should be done free. Those conversations should be had free of the bad incentive cycle of having a insurance person who makes a commission off selling you that product now also advising you to buy that product. That is what you call a conflict of interest and a bad situation. So speaking to a financial planner who is a fiduciary and fee only, where they only get paid by you, the client, don't get any form of commissions, are not affiliated with an insurance company, is actually a very healthy thing to do, because you will get unconflicted, zero conflict of interest advice about whether or not that's a good product for you. So to wrap this up, my case is this should all be done with a professional. That's why I do what I do. My clients appreciate that I speak candidly, but also that we're going to address all these things. There are a lot of things that you can do that are behavioral, that don't require guessing games. However, you still want to think of them in the framework of a cohesive strategy. All right. And the idea being you don't know what you don't know as an individual. Financial planners like myself, especially fee only fiduciary planners, have the benefit of working with many clients and having many experiences and can distill those down and help clients avoid mistakes, right? The idea here is mistakes are costly. You don't get do-overs when you make mistakes, right? So I can't tell you how many times someone has called me, made an improper rollover from a 401k to an IRA. All of a sudden they're paying 40% taxes on it and their portfolio is down from a million to 600,000. It's a disaster. And there's no way to go back. You can't get a do-over, right? And that had nothing to do with investing. That was just a mistake because you didn't seek out help or advice. So my case is seek out help and advice. Work with a professional, right? So specifically and only fee only fiduciary financial planners and financial advisors. If they are fee only, it means they only get paid by the client. There are no commissions, no kickbacks, no affiliate relationships, no outside sources of influence that will dictate or determine what that planner or advisor advises you on. And then if they are a fiduciary, it means they have to work on your best interest and they are regulated by the US government, the SEC, FINRA, broker, a whole bunch of places to ensure that they meet that fiduciary standard. So you can watch and read more guides that I have about what is a fee only advisor, what is a fiduciary, and you can find all those on my website. But I'll give you guys one more call out here at the end. My purpose in this presentation is to arm you with information that will help you make good decisions. But at the same time, it's to encourage you to work with a qualified fee-only fiduciary financial planner. Okay, I am a fee-only fiduciary financial planner. My business is called Peak Financial Planning. And I hope that if you've watched this far, you are understanding how important it is to make use of this time you have during the retirement risk zone to make good decisions, to practice strategy, and arm yourself with knowledge and models so that you have the retirement that you hope for as opposed to hoping for the retirement you wish, right? You can guarantee it, or you can get as close to guaranteeing it as is humanly possible by making use of the time you have and putting effort in leading up to it. But you will live with anxiety for the rest of your life if you try to jump off that cliff the day before, the month before, even the year before retiring and just hoping that you've set yourself up appropriately. So you can click the link below. It'll take you to a survey and a page that talks you through what is the free consultation I do with clients or with prospects. How do you prepare for it? What types of questions can I help answer? And you can it'll look like what I have here on the screen. The meeting is called Navigating the Retirement Risk Zone. Everything I talk about is navigating the retirement risk zone. And I would love to speak with you. If you fill out the form in the application there, we can find out if we're a good match to actually get together and speak. And if you would like more information or you just want to learn more before taking any action, you can visit my YouTube channel, Peak Financial Planning. Just type that in YouTube. Or you can visit my website. I have tons of blog articles and video guides on there about all the subjects we talked about in this video. Thank you for your time and attention. I hope you found this video helpful, and I'll look forward to speaking with you if and when we get the chance to. You can use the button below to schedule that time. Thank you so much.